Hi, I want to talk about the 2021 Ontario budget, and in particular, the financing of Ontario's debt. Because the interest that we pay to finance our debt comes from the same pot of money that might be spent on long-term care or housing or schools. The borrowing increased last year. Shouldn't be surprising because during the pandemic, we had to protect people and protect the economy. Going forward, about 50 to 60 billion dollars a year needs to be financed. That's the deficit, the budget deficit, plus debt, older debt that has matured and needs to be re-borrowed, refinanced. Last year, during most of last year, interest rates were low. There was a danger of an economic slowdown, and so interest rates were low, and short-term interest rates were even lower than long-term interest rates. Um, what happened in the early part of 2021 was that interest rates went up, and you can see that on this figure here. The red arrow uh, gives you what happened during January, February, and March. Interest rates were low for most of 2020. Uh, they were just a little bit, Ontario's borrowing costs were just a little bit below 1.5% per year. But we know that the central bank was targeting something like a 2% inflation target. So, put yourself in the place of somebody who's managing a retirement fund or something. They say, oh, inflation is targeted to rise at 2% of a year. I'm only getting 1.5% on my government bonds. Maybe I want to invest somewhere else to get a better return than inflation. And so naturally, the price of Ontario bonds um, went down, and interest rates, the rate that we would pay to borrow to finance the Ontario budget, went up. And the thing is that interest rates were low for most of 2020 and then rose early in 2021. What happened and what I saw in the budget that came out in the spring of 2021 in Chapter 4 is that the average term of borrowing. So, for example, you might borrow money for 5 years, so that's a 5-year term, or you might borrow money for 10 years. That would be a 10-year term. And if you borrow money for a shorter term, like 1 or 2 years, the government sometimes does that. Last year and still, you would get a lower interest rate than if you borrowed over 10 years, for example, by issuing a 10-year bond. The thing is, you might get a lower interest rate for a few years if you borrowed short term, but you can lock in low interest rates by borrowing long term. You pay a little bit more at the beginning, but over time, you end up paying less. So, to summarize, if you borrow at a shorter term, you get a lower interest rate, but you take on refinancing risk because you don't know what the interest rate is going to be when it comes time to roll over the debt. What happened last year, according to the budget, is that the average length of borrowing decreased. It went from 10.9 years to 10.7 years. And that is an average over all of Ontario's debt, all of the bonds that the government of Ontario has issued. So, from that point of view, we were not trying to borrow for a longer term and lock in lower interest rates. And in fact, if you look at the budget predicts or looks at the debt, government debt markets, and it can see where interest rates are heading. And there's a prediction in the Ontario budget document which says that interest rates will go up in the future. So 1.9% next year, 2.4% the year after that, 3.2% going up going up every year after that. And it's possible that interest rates could change over time. There's a line in the budget which says a 1% point change in interest rates, either up or down from the current forecast, is estimated to have a corresponding change in, I'm just quoting here, is estimated to have a corresponding change in Ontario's interest costs by over $750 million in the first full year. So this is $750 million of extra interest that Ontario, that we would have to pay if interest rates went up by 1%. So that's the risk we're taking by having to refinance 50 or 60 billion dollars of debt every year. And interest rates are going up. So if you look at the federal government budget, they're actually extending the length of the borrowing. So the federal government is issuing longer bonds so that it can borrow over a longer term to lock in the rates, which it believes are still low right now. In fact, the federal government was looking at reopening a 50-year bond. So the federal government was looking at doing some borrowing over 50 years to lock in for a very, very long time a lower interest rate. So when was the last chance to lock in those low interest rates where Ontario could borrow for 10 years at something like 1.5%? Well, it turns out it was basically at the end of December 2020. And at that time, the interest rates started to go up. Now, we could still decide to lock in long-term rates, and it's possible that rates could go down. So I'm not saying the right thing to do was to lock in long-term rates. But my question is, when was the last chance we had to actually look at the question, to try to ask the experts and make a decision about the risk involved in locking in longer-term rates? And unfortunately, the last chance we had to ask that question, to think about what to do, was about the beginning of 2021. And that's when Premier Ford had to change finance ministers because his previous finance minister got caught going on vacation to the Caribbean during the second wave of COVID, and in contradiction to the government messaging to people in Ontario to avoid travel during the pandemic. So it was a very unfortunate time. And so maybe if you look at the red arrow in the picture, the last chance we had to ask the question, should we be borrowing longer term to lock in low interest rates? The last chance we had to ask that question was in January of 2021 or so. And after that, interest rates for the government of Ontario to borrow longer term, in other words, issue 10-year bonds, jumped from about 1.5% to over 2%. Now, going forward, we may still decide that it would be a good bet to borrow longer term to lock in the current interest rates, which may not be particularly high. And I think the federal government is making that bet. But I think it's important to be able to ask these questions for the elected politicians to always be in a position to ask the civil servants, what are the facts? What's the market situation? What are the current interest rates? What are the refinancing risks? That's part of holding the government accountable for its finances. And again, I can't stress too much that this matters, even though it's not too exciting. This matters because the same pot of money that we use to pay interest on our debt that we should be trying to minimize, this same pot of money is the money that's used to pay for the things that we need: housing, long-term care, hospitals, schools, roads, bridges, fighting climate change. And it's important for elected officials to keep an eye on how we are financing our debt. Thanks for listening.